Talk about fair value gaps today. I intend to keep it like very brief and basic. Okay, so let's get into it now. What is the fair value gap? The fair value gap is simply a gap in price when the market offers only buyers or sellers. Now, the way the market moves, right? The market is seeking for just two things: liquidity and inefficiency, right? Inefficiency in the sense that only one side of the market is being offered. So the market tries to balance price by offering both buyers and sellers in the market. Okay. So let's jump into it very quick. Now, looking from the chart here, we have like bullish candles and bearish candles. Bearish candles here in my chart are represented by the black candles going down, and then the bullish candles are represented by the green candles going up. Do you understand? All right, so let's quickly go into the concept. Now, from this market, as you can see here, right? If you take a look at this bearish candle, right? This bearish candle, from this week to this week, inside here, what is happening inside here is just one single bearish candle to the downside. That means inside this candle, only sellers were present inside this candle. There was no buy side, and that is what we call a fair value gap, right? So you do something like this from the week high of the next candle and the week low of the previous candle. From the week low of the previous candle and the week high of the next candle, this gap inside here, this downside, this is what we call what a fair value gap, because inside there only sellers were present inside here. Do you understand? So that's what we call a gap in price. And what this does, the market tries to balance things like this, because this is what an inefficient price delivery. Okay. Now, the next thing here, it says the fair value gap can be used as continuation of the current market condition. Now, from this example right here, as you can see from this chart, we are bearish, right? From up here to down here, it's just one direction going down, which is bearish. Okay. So now, if a fair value gap can be used as a continuation for the current market direction, how do we now get bearish entries from this? How do we now get bearish continuations from this particular movement, right? Now, what do? You mark out the fair value gaps. Now, let's use it as an example. From this week low here to this week high, that little gap there, this little gap inside here, this is a fair value gap. And now they said what a fair value gap can be used as a continuation of the current market direction. That means when price gets back into that fair value gap, we want to sell from there. We want to use it as a continuation to go down. You understand? To continue the bearish trend. And you can see the same thing here again. Same thing here again. This week high and this week low, right? This bearish candle, this heavy bearish candle, presents just what? Just sellers. There's only sellers inside here. So the market tries to balance price like this. So the market traded back into it, tried to balance it, and then continue lower. I can still show you one more. We have this week high and this week low. Inside here is only sellers. There is no buy side. There's no buyer inside here. So the market traded back up. You understand? It's the same thing over and over again. So when you're in a bearish market direction, right, you want to mark out all the bearish fair value gaps that formed on its way down. So we tend to use those fair value gaps as what? As entries to continue the bearish trend. Now, the next point says the fair value gap can be used as an entry point, which is what I just showed you here. So when you mark out the bearish fair value gaps here, here, and here, this is, mind you, this is a 4 hour time frame, right? So you wait for price to trade into that fair value gap, right? And then reject away from it, that right there, you can get your entry inside that fair value gap. So the next point says what? A fair value gap that overlaps with a liquidity void should be used together as a fair value gap. This is a very simple one, right? So we have like a bearish candle here. Mind you, it takes three candles to form a fair value gap, right? So we have the first candle here, close bearish, create this wick here. Now the next candle opens with a gap down. You understand? The next candle opens and then gap down. You understand? Leaving this gap here. This is a void. This is what? A liquidity void, because there is nothing here, right? And now the third candle opens, creates the wick up. You understand? Now, how do you what do you mark here as your fair value gap? You mark this high. Now, mind you, from other examples, we marked this wick low as a fair value gap. You understand? But in this case, where we have a void, you consider this also as part of the gap. So you mark the body. You understand? The close of the body. So this becomes your fair value gap. Now, this is only when we have a liquidity void that overlaps with a fair value gap. So these three candles now gives you your fair value gap. You understand? Now, the last point says when a fair value gap has been tapped without completely filling the gap, the remaining portion of the fair value gap can still be used. Now, this is a very good example here. So we have this fair value gap here, right? This low and this week high. We have a fair value gap right there. So this is a fair value gap here, right? Now, I want you to notice something. This green candle here, this green candle came in and traded up into here, right? Did we fill this fair value gap completely? No. We have this remaining portion here. This week traded up into almost 50% of this gap, but we have this remaining portion here. This portion here can still be used as a fair value gap. Yes, this remaining portion up here, this remaining portion up here can still be used as a fair value gap. Do you understand? That's the last point, right?